Hello and welcome to another episode of Real Rich Advice. Today we're going to be talking about lenders. So a large percentage of our transactions, a portion of the house is financed. And with that, there are some factors to consider when choosing a lender. The three groups of institutions that we have in our market are broken into credit unions, large banks, and small mortgage brokers. Credit unions, there are some positives to choosing credit union. The main thing is when it comes to rate, especially if you're affiliated with that credit union. For example, you might work at the UN, the World Bank, the Pentagon, something like that. And therefore, that credit union can offer you a better rate than what might be available in the market. Some of the downsides to choosing a credit union is typically these unions work in a more structured environment where they might not be available off hours, not outside of the 9 to 5 business hours, as well as they often have pretty restrictive guidelines. That means that they're looking to do a loan that meets a certain profile. And if you're outside of that profile, that sometimes can make things tricky. The second is large banks. They share some things with credit unions in the fact that they, again, try to fit a mold. And given that they're a larger bureaucracy, I sort of compare them to dealing with a freight liner. It can be really economical if you really are the right person for them. They can often get better rates. Recently, we saw that with jumbos. With Wells Fargo, the jumbo rate was significantly better if you dealt directly with Wells than if you dealt with a mortgage lender that was writing a Wells Fargo loan. And the other thing is sometimes they have incentives because they need to do a certain amount of loans in certain areas to help diversify their portfolio. So there are some pros to that. But again, you can have some issues that are pretty common with large organizations. They can be a little bit rigid in their guidelines, and sometimes, not all the times, but some of the loan officers can be a little bit hard to be reached as they're trying to carry a large geographic area within their portfolio. The last is the small local brokerage style lenders. So these are companies such as like George Mason, Prosperity Mortgage, Caliber Home Loans. These are small institutions that specialize in a local market. Some of the advantages here is they're very familiar with the market. They're often reachable outside of traditional business hours. And they understand how our market works, the timelines, and all those things. They're accustomed to our process, and therefore they can be pretty strong when it comes to trying to get an offer accepted. So those are just a little bit of the pros and cons when it comes to the different mortgage institutions. But when it comes to choosing the actual loan officer, there are 3 R's we think you should consider.
Yeah, the 3 R's tie into what Jordan was saying during a couple seconds ago. First is rate. Rate is really important because depending on what the rate is, you could pay a lot more or pay a lot less over the life of the loan. So we want to make sure that our buyers get the best rate they can, as well as a rate that the loan officer can deliver. The second R is responsiveness. We want to deal with lenders that are responsive. Oftentimes, buyers are buying houses on weekends, Saturdays, Sundays, and we need to call a loan officer on a Saturday or a Sunday. Oftentimes, we need some documentation from them. We need a letter from them. Sometimes they need to talk to the buyers on the weekend to get the buyer in a position that when their offer is submitted, that if the other agent needs to talk to them, that the loan officer is available. The third is the reputation. The reputation of the bank, the lending institution, the loan officer is very, very important. Certain banks in this area, certain loan officers, certain lending institutions have much better reputations. And we know that on the day of closing, the papers are there on time, the money is there on time, the loan rate that the buyer locked in at is actually the rate they're getting, as well as when the listing agent sees the letter from the lender, that the listing agent will know that it's a reputable person and a reputable institution behind them. And then again, so it's important for the buyer as well as the seller that everybody can deliver on the day of closing. So those are the 3 R's: rate, responsiveness, and reputation. If you have any questions for us, feel free to put it in the comment box or feel free to send us an email. Thanks for watching.